The collapse of FTX and Alameda Research has done serious damage to the crypto market, and it seems that Solana was one of the most affected crypto projects. Now, this makes sense given that Solana was the de facto exchange chain of FTX and that both FTX and Alameda were big investors and participants in Solana's ecosystem. Today, I'm going to give you a quick recap of Solana, tell you what's been going on with the project, and examine whether Sol will survive the FTX Alameda meltdown. I want to start with some transparency, and that's that I no longer hold Sol as part of my crypto portfolio. If you're subscribed to my weekly newsletter, you'll know that Sol accounted for almost 8% of my portfolio until last weekend. Note that you can find the link to my weekly newsletter in the description. Now, my decision to sell Sol was based on many factors, including the current state of the crypto market, but there is no denying that the FTX Alameda situation was top of mind for me. Now, I must also stress that this is not financial advice, it's just my opinion, and you will obviously have yours. That said, I will give both a bearish and a bullish case for Solana in today's video. That's because there does seem to be some hope for Sol on the horizon. It just looks very far away from where I'm standing. That's just my perspective though, and I would love to get yours in the comments section. Now, as many of you will know, Solana was founded in 2017 by former Qualcomm engineer Anatoly Yakovenko. The Solana blockchain was built by Solana Labs, which is based in the United States, and its ongoing development is coordinated by the Solana Foundation, which is based in Switzerland. Solana raised $25 million across various ICOs between 2018 and 2020 and raised an additional $314 million from crypto VCs last year. FTX and Alameda Research were two of the largest investors in Solana and were two of the largest investors in Solana's ecosystem, that is, crypto projects building on Solana. This is because Solana's original goal was to become a decentralized alternative to centralized stock exchanges like the Nasdaq. Now, this is a goal that FTX and Alameda founder, Sam Bankman-Fried, could get behind, given that his endgame was also to displace the existing institutions with his own infrastructure. Solana's mainnet went live in 2020 and its blockchain is still technically in beta. Recent comments by Anatoly suggest that Solana may soon be entering its alpha stage, which is surprising given that the Solana blockchain continues to experience issues. More about all that later on. Under the hood, the Solana blockchain uses a novel proof-of-stake consensus mechanism that timestamps transactions using a technology called proof of history. This consensus mechanism makes it possible for the Solana blockchain to process up to 65,000 transactions per second. Until recently, the Solana blockchain was secured by almost 2,200 validators. Solana's validator count was just 1,850 when FTX and Alameda collapsed. This suggests that FTX and Alameda were running lots of Solana validators. Note that Solana transactions are processed by clusters of up to 150 validators. Now, Sol is the native cryptocurrency coin of the Solana blockchain. Like all cryptocurrency coins, Sol is used to pay for transaction fees. 50% of every transaction fee is burned, with the other half going to validators. Obviously, Sol is also used for staking. Staking rewards are currently around 8% for both validators and delegators with a 5-day lockup. There is no minimum stake for validators or delegators, though the hardware requirements for running a validator are very high. Misbehaving validators are also slashed. Staking Sol as a delegator can be easily done using the Phantom browser extension wallet, which also acts as a gateway to Solana's ecosystem. The Phantom extension has been downloaded over 2 million times on Chrome, and DappRadar's data suggests that Solana's dApps have at least 500,000 monthly active users. The focus of Solana's ecosystem was initially DeFi. This was in large part due to FTX, which had its own DeFi project called Project Serum. What's crazy is that the order book-based Serum DEX lay at the heart of Solana's entire DeFi ecosystem, providing liquidity and pricing data to many other major DeFi protocols. To my knowledge, most of Serum's liquidity came from FTX and Alameda. Now, the massive drawdown in the total value locked in Solana's DeFi protocols following Terra's collapse in May therefore suggests that this is when FTX and Alameda started to experience the issues that ultimately led to their collapse. You can learn more about the FTX and Alameda situation using the link in the description. I digress. Now, it's barely been 3 months since I last covered Solana, but a lot has happened since then, and not just stuff that's related to Alameda and FTX. Shortly after our last update, a group of Solana projects announced the creation of a cross-chain messaging protocol. If you watched our Cosmos update from around that time, you'll know the announcement seems to have been a not-so-subtle response to Cosmos's announcement about its upcoming interchain security. To my mind, Solana's subsequent announcement underscored the multi-chain future of crypto. Institutional crypto custodian Fireblocks also announced that it had added support for Solana DeFi protocols and Solana NFTs. In case you missed the memo, Solana was becoming increasingly popular with institutions. This was in large part due to Solana's close relationship with FTX and Alameda. In early September, a crypto project called Sui announced that it had raised $300 million from various crypto VCs. Now, this is significant because Sui has its roots in Facebook's failed digital currency project Diem, aka Libra, just like Aptos, and Aptos is considered by many to be a Solana killer. This arguably makes Sui a Solana killer too. This is in part because both Sui and Aptos are coded in Move, a novel programming language developed by Diem's developers. Move is based on the Rust programming language used by Solana, but is much more developer-friendly, or so I've heard. For those who don't know, Sui and Aptos are considered to be Solana killers because they're all backed by the same entities. FTX Ventures was a big investor in both Aptos and Sui, and Aptos co-founder Mohammed Sheikh confirmed in an interview that the project was working very closely with FTX. Fortunately for Solana, Aptos and Sui's exposure to FTX so early on in their development could set them back quite a bit. Unfortunately for Solana, its even higher exposure to FTX could mean that it will be the crypto project that picks the shortest straw. More on that in a moment. Anyways, another Solana-related announcement in early September came from Coinbase, whose cloud division spun up archival nodes for the Solana blockchain. This is significant because Solana's full transaction history was only being stored on Google Bigtable, which made it quite centralized. In mid-September, SEC Chairman Gary Gensler said that proof-of-stake cryptocurrencies could be securities. Although Gary's comment was likely about Ethereum's transition to proof-of-stake, Solana Labs was recently accused of selling securities, that is, SOL, which could put it at risk. At the end of September, the Helium community voted to migrate its peer-to-peer networks from the Helium blockchain to the Solana blockchain. This is something we had predicted in one of our earlier Solana updates. Were it not for the FTX Alameda situation, this would have been bullish for HNT. However, the FTX Alameda situation we're in has made Helium's Solana integration incredibly bearish for HNT, and not just because it's a part of Solana's ecosystem. Back in February, Helium raised $200 million in a funding round co-led by, you guessed it, FTX Ventures. At the end of September, Circle also announced that it would be expanding its USDC stablecoin to 5 additional smart contract cryptocurrencies and introducing its own cross-chain interoperability protocol. Now, this is evidence that Circle is moving away from Solana, which is apparently the official chain for USDC. In early October, the Solana blockchain experienced yet another outage. This time, it was due to a misconfigured validator node. For context, most of Solana's outages have been due to spam transactions facilitated by its blockchain's fixed transaction fees, which are extremely low. In mid-October, Aptos announced its mainnet launch, and if you watched our video about the project, you'll know that the launch was pretty badly botched. It still boggles my mind that a project with so much funding and backing managed to make so many mistakes, but hey, let's not go there. At the end of October, a crypto project called Trip Protocol announced it would be creating a decentralized alternative to ride-sharing apps like Uber built on Solana. Now, this is the kind of dApp that could reach serious mass adoption, and it's such a damn shame that it's been set back by recent events. In early November, almost half of Solana's validators went offline after a German cloud service provider called Hetzner banned all crypto companies and projects from using its services. The huge impact this had on the Solana blockchain raised even more questions about Solana's supposed decentralization. Luckily for Solana, this bearish news was quickly overshadowed by all the bullish news that came out of Solana's annual Breakpoint conference in Lisbon. The biggest news was that Google Cloud had begun running a validator on Solana, which logically means that Google had purchased lots of Sol. Google Cloud also announced that it had released software to index Solana's transaction history, which you'll recall is being stored on Google Bigtable. Now, this is significant because Anatoly had mentioned in earlier interviews that it was extremely difficult for developers to analyze Solana's transaction history. Helium also announced that it was building out a mobile network and would be giving out SIM cards with a free 30-day trial to everyone who purchased Solana's upcoming Saga phone. Helium also recently partnered with telecoms giant T-Mobile to increase 5G coverage in rural areas. Another great initiative now under threat. Now, the announcement that everyone seemed to miss was that Solana's Neon layer would be launching sometime in December. If you've been keeping up with our Solana updates, you'll know Neon supports the Ethereum Virtual Machine, or EVM. EVM compatibility could supercharge Solana's adoption. As a cherry on top, Circle announced that it would be bringing its recently released Euro stablecoin to the Solana blockchain next year, making Solana the second smart contract cryptocurrency to support EuroC after Ethereum. This suggests that Circle hasn't given up on Solana just yet. And then FTX and Alameda blew up. Not surprisingly, the price of every single cryptocurrency that FTX and Alameda had invested in instantly plummeted. As FTX's de facto exchange chain, Sol was at the top of the list. Sol's price was only the tip of the iceberg, however, as its entire ecosystem also went into crisis mode. Loans were liquidated, wrapped tokens issued or backed by FTX and Alameda depegged. The total value locked in Solana's DeFi protocols fell off a cliff. The upgrade keys for Project Serum and the Serum DEX were revealed to be in the hands of FTX, causing the community to fork what was left of the protocol. Sol holders also feared that nearly $1 billion of Sol set to be unlocked would be sold. Now, their fears were calmed after the Solana Foundation announced it would be postponing the unlock of the 30 or so million Sol, once again, though, calling Solana's decentralization into question. To add insult to injury, Google Cloud announced that it will also run validator nodes for the Aptos blockchain and that it had partnered with the project for a developer accelerator program. The timing couldn't have been worse given the circumstances. So, as you can see, Sol's price was holding up quite well until the FTX Alameda situation. Now this is impressive considering that Sol's supply has increased by around 15 million since August. Assuming an average price of around $30 per Sol, this means Sol experienced up to $500 million of sell pressure. On the demand side, it seems that Solana's NFT marketplaces were absorbing most of this supply shock. Institutional investment vehicles for Sol also still have more than $100 million invested at Sol's current prices. This is scary considering some of these ETFs were seemingly issued with the help of FTX. What's even scarier is that analytics on the Solana Explorer show that transactions on Solana have fallen off a cliff over the last week. The silver lining is that the analytics also suggests the drop in Solana's validator count was due primarily to Hetzner's crypto ban and not the FTX Alameda situation. In any case, it's clear that the demand for Sol is down, and it's easy to understand why. Some have begun to question Solana's future, and this is in large part due to the massive amount of Sol that FTX and Alameda will be forced to sell when the time comes to compensate their creditors. According to the CoinDesk article that kickstarted the concerns about FTX and Alameda's balance sheets, Alameda held roughly $1.2 billion of Sol in June. Assuming the price was around $40 per Sol at the time, this works out to around 30 million Sol held by the market maker. As for FTX, recent leaks suggest the exchange held around $1 billion of Sol as of a few weeks ago. Assuming an average price of around $33 per Sol, this means that FTX held an additional 30 or so million Sol. Now, it's not clear how much Sol FTX and Alameda currently hold. For what it's worth, these numbers are consistent with the recent disclosures by Solana Labs and the Solana Foundation about their exposure to FTX and Alameda. Solana Labs and the Solana Foundation sold a total of 58 million Sol to FTX and Alameda over the course of more than 2 years. At current prices, this Sol is worth roughly $900 million and accounts for more than 15% of Sol's total supply. While not all the Sol held by FTX and Alameda is liquid, the fact of the matter is that it will inevitably be sold at some point as part of their bankruptcy proceedings. As I mentioned a few moments ago, Sol managed to survive $500 million of sell pressure over the last 3 months. However, this assumes that the 14 million Sol that entered circulation were sold, which is unlikely. This means that Sol may not be nearly as resilient to sell pressure as it seems. More importantly, the demand for Sol is not nearly what it was even just 2 weeks ago. This could make it difficult to absorb the hundreds of millions of dollars of sell pressure that's coming, and that's just from FTX and Alameda. There are certainly other institutions and retail investors who will sell their Sol. Never mind all the promising Solana projects that will die because of their exposure to FTX and Alameda. To make matters worse, the bottom of the crypto bear market probably isn't in yet. This means that Sol will go lower even without all the sell pressure from these entities. Its long-term price chart suggests Sol could fall to $8. This would be consistent with the estimated percentage loss in other large alts. Now, if you're wondering how long this crypto bear market will last, be sure to check out our video about that from a few months back. I reckon it still holds true, and we'll be doing another video about the potential catalyst that could take us out of the crypto bear market lows in the next week or two, so stay tuned. Now, whether Sol will ever rally back to its all-time highs and beyond depends on the project's upcoming milestones. These can be found in an October blog post on the Solana GitHub and in interviews with Solana founder Anatoly Yakovenko. The October blog post in question is called, quote, Solana Network Upgrades, and it appears to have been published in response to the outages Solana had experienced earlier that month. The next milestone on the list is the introduction of different fee markets for different types of transactions. After that, Solana will be increasing the size of the blocks on its blockchain. This should make Solana even faster, but it will likely make its blockchain even more centralized and could further compromise its security as a result. More about the trade-offs of TPS using the link in the description. The third milestone noted in the blog post is compact vote state, which can be simply understood as reducing the size of certain transactions. This could further increase Solana's TPS while protecting against some of the centralization and security issues that could arise from the block size increase. Now, what's funny about these milestones is that they're eerily similar to Aptos's milestones. Aptos is currently working on implementing different fee markets for different types of transactions. Solana's inspiration doesn't stop at transactions either. That's because a repository on the Solana GitHub suggests that it's looking to make it possible to build on its blockchain using the Move programming language. This is significant because the difficulty of building on Solana has been one of the project's biggest drawbacks. The Solana GitHub also contains many repositories related to on-chain governance, something that's been in the works for a while. Now, I don't imagine Solana is in a rush to roll out its on-chain governance now that a significant chunk of Sol's supply is in limbo via FTX, Alameda, and other affected crypto VCs. Speaking of which, Anatoly dropped a bombshell about Solana's development during a panel discussion at the project's aforementioned Breakpoint conference earlier this month. He basically said that he will consider Solana to be out of beta once a second validator client has been completed. Now, this is huge news that seems to have flown under everyone's radar because of the FTX Alameda situation. To be fair, Anatoly only said that he would consider Solana to be out of beta at that point, not that it necessarily would be. Even so, it's the closest thing we've got to an alpha timeline thus far. The thing is that Solana still seems to be unreliable, and its blockchain and especially its ecosystem seem to be in a more vulnerable position than ever. This makes it hard to understand how Solana could be considered complete when it's still experiencing so many issues. This brings me to my concerns about Solana, and my first concern has to do with Solana Labs and the Solana Foundation, specifically their balance sheets. The blog post detailing their exposure to FTX and Alameda suggests that the Solana Foundation only has around $100 million of cash on hand. In case you're wondering, the foundation only had around $1 million of cash on FTX when it collapsed. However, it had $200 million worth of FTT and SRM sitting there. These tokens are now essentially worth nothing, along with the 3.2 million shares of FTX the foundation also holds. Frustratingly, the blog post didn't reveal how much runway Solana Labs has, but Anatoly mentioned on Twitter that it has enough money in the war chest for another 30 months or so. Anatoly specified that this runway is in dollars, which begs the question of how much SOL Solana Labs holds. Anatoly also confirmed that Solana Labs had no assets on FTX, which is certainly good news. The bad news is that FTX and Alameda were the primary money funnel for the Solana ecosystem. What's more is that Solana's association with FTX and Alameda could make its ecosystem unattractive to other VCs. What this means is that the Solana Foundation and Solana Labs might be the only entities willing to invest in Solana's ecosystem for a while, and the cash they currently have on hand won't be nearly enough. This means they might have to start selling SOL, which would cause its price to fall even further. This relates to my second concern, and that's regulation. As I mentioned earlier, the SEC is watching proof-of-stake cryptocurrencies very closely, and Solana Labs is already involved in a securities suit. The fact that the SEC and others are now investigating FTX means that Solana could come under additional scrutiny. Now, my final concern about Solana is straightforward, and that is competition. Anatoly admitted in an interview that the Solana team is anxious about Aptos and Sui because of how developer-friendly they are. Aptos and Sui also have an absurd amount of big tech backing due to their DM origins. There are also other smart contract cryptocurrencies like Polkadot, Near Protocol, Avalanche, Cardano, and Ethereum, which are fundamentally fighting for dominance of the same critical crypto niche. These crypto projects aren't nearly as exposed to FTX and Alameda as Solana was and continues to be. Now, with all that said, there is one thing that gives me hope for Solana, and that's all the promising projects in its ecosystem. Make no mistake, Helium, Trip Protocol, and others have the potential to change the world. Sol will benefit immensely if they succeed, assuming they stay on Solana, of course. All Solana must do is survive the bear market. Now, I am confident that it can, but I also know that Sol will likely be going a lot lower before the bulls return. When the time is right, I may start to accumulate Sol again, assuming Solana hasn't been sucked into the hellish vortex that FTX, Alameda, and SBF are headed for. One thing's for sure, though, and that's that Solana will be much better off without their influence.